Okay. Thank you very much. Do you hear me well in the back of the room? Okay. So I'm very happy to be here and talk about what's been a hot topic in the last few years and is going through a lot of ups and downs. This is FinTech and the connection between FinTech and decentralized finance. I'll give you a mixed review of that. There are some positives, some negatives, as you'll see during my talk. Now, I'm very much looking forward to hearing your feedback as well. And the way that I'm going to do it is I'll give the talk for about 45 minutes, and then I will take the questions. You can submit the questions on the app like you've done in other sessions, and you can do it during the session. I will collect the questions at the end, and we'll try to answer as many as possible in the time that we have. Okay? So that'll be the plan. So that's the topic. Here is a brief roadmap to what we're going to do. I'm going to start by telling you what I think FinTech is, what's new about FinTech, and how is it different from things we have seen in the past in finance. That is related to the topic of decentralization. Then I'm going to go through one aspect of FinTech and decentralization that looked quite promising a few years ago, but I think hasn't gone very well. This is peer-to-peer lending, and I'll talk about some of the lessons we can take from that, also thinking forward. I'll then connect to what is currently still very hot on the agenda, and you hear very fierce debates about. This is blockchain and DeFi, decentralized finance, DeFi, and then I'll conclude. As I said, I'll leave time for questions at the end. So let's dive into FinTech. What is FinTech? One thing that we know from the history of finance is that there was always technology. There were constantly technological improvements in finance that continued to shape the way the financial industry works and make things more and more efficient. What you see here is a timeline that goes a lot back in time, several hundreds of years, and you can trace technological innovations like accounting systems and credit cards that happened over time and gradually made the financial system better and turned it into what we see today. So, for example, just think about a few years ago, more than a few years ago, I would say by now, but not that far ago, something like ATM. That was a technological improvement that changed the financial system. Or think about credit cards, for example. All these things can be thought of as technological innovations that changed the financial industry. But still, we started hearing about FinTech more recently. Okay? I think it's been about a decade ago that this buzzword came up and everyone started talking about this new trend of FinTech. So we want to understand, what is it? Why was it so new? And how is it different from the technological innovations that we've seen for years and years? I would say there are two quick observations that come to mind. I will state them now, but I will also say later that they are not telling the whole story. Those two quick observations are, one, that the pace of technological change in the last few years, the pace of technological change in the financial system has been quite fast. You kept seeing more and more innovations coming up, and this was somewhat unprecedented. It was much faster than we've seen before. Okay, so that's one quick thing that we can say. Something else that I would say has more substance, and this is something I will come back to a lot today, because it also links us to decentralization. This is the idea that what's new about this FinTech revolution is the fact that a lot of the innovation came from outside the financial system. Usually, in the past, you saw that technological innovations were adopted by the financial system, and the financial system constantly tried to improve the way it was doing things. I think with the fintech revolution, a lot of the pressure came from the outside. There were a lot of new players that were trying to take over the position of the incumbents and threaten their control in the financial system. Okay, so that's the second distinguishing feature of the fintech revolution. So how did I come into it? So back in 2016, we sat around. I'm an editor in an academic journal, one of the leading academic journals in finance, and we kept hearing this buzzword fintech from the industry. There was almost no research in academic finance about fintech. Okay, nothing that you could directly relate to the phenomena that we were seeing around us. So we said, okay, there is no research about it. Why don't we do a call for proposal, encourage people to propose new research on fintech, and with that, we will have an idea of what fintech is and how the academic research is going to shape it up and help us understand it better. So we did this call for proposal that led to the FinTech initiative with a special issue, first of its kind in the literature. And it gave us a very good understanding of how people think about fintech. You know, one thing you can do is a word cloud. Word cloud tells you, you know, if you look at all the proposals that were submitted as part of this initiative and you collect the common words, you can see what people are thinking about when they are thinking about fintech. And, you know, some of these words here are obvious. Some of these words here are things that you will always see in finance papers. But some of them are also unique and kind of point to the fact that there is something new going on. For example, platform. A lot of what we were starting to see was new platforms that were emerging and were trying to take over existing financial arrangements. Another thing is peer. The idea that now it's not just based on financial intermediation, but a lot of it is going to go through peer. Something else that you can see there in the bottom, not the biggest, but I think quite important, is trust. A lot of the fintech revolution came as a result of a trust crisis. The fact that people lost faith in the financial system and wanted to replace it with something else. Okay? So we were looking at that and understanding a little better what fintech is about. You can also see it from the distribution of topics, what people are writing about when they are writing about fintech. And what's quite striking here, and here we are talking about 2017, the most common topic at that point was peer-to-peer lending. At that time, this was kind of at the frontier of the fintech revolution, and I'm going to come to that in a couple of minutes, kind of telling you the somewhat sad story of peer-to-peer lending, how it didn't really live up to the expectation. And I'm going to use that as a case study to understand better some of the tensions that we have with fintech. Okay? So you see the peer-to-peer lending certainly as a dominant topic at the time. Another one that was dominant was blockchain, although blockchain still remains quite hot and highly debatable. And I'm going to talk more about that later. Okay? So what is the overall emerging theme that I'm taking from all this experience? And this is going to structure my discussion going forward. Really, there is an emerging theme that is coming out of research on fintech. And when you talk to people who do fintech and have a lot of passion for fintech, this is the idea of decentralization. Okay? And a lot of what we'll talk about today is decentralization. Nowadays, when people talk about fintech, in many cases, they think about decentralized finance, which is also abbreviated as DeFi. So a lot of it, at the end of the day, is decentralization. And this, I would say, had a huge impact on the evolution of fintech. This was one of the main motivations behind the fintech revolution, decentralization. What's the idea behind decentralization? So if you think about how finance always worked, finance always worked through intermediaries. There are always big players. We think about them a lot as banks. They don't have to be banks, but banks are the dominant big players. And they are conducting a lot of the financial transactions. They are capturing a lot of the rents, okay? The motivation behind the fintech revolution and the decentralization was to get rid of these big players. Essentially, to try to reimagine a new financial system that will be decentralized and will not rely on these big financial intermediaries, okay? That was, I would say, the main motivation behind fintech and a lot of the things that you see in this new so-called revolution. Now, I'll talk in a second about what did they have against banks and against those big financial players. But I think one thing we can say right away is that the timing was not a coincidence. The timing when fintech started to arise and decentralization became such a hot topic was in the aftermath of the financial crisis of 2008. Think about it. What everyone saw in the aftermath of 2008 was you see a big meltdown. And when you start understanding what was going on, you basically realize that the big financial intermediaries, big banks, were not really doing their job. They were taking excessive risk. They put the financial system at risk. They put the economy at large at risk. And at the end of the day, people had to pay the price. And the financial intermediaries, many of them kind of kept going on with their business. This was kind of the thing that was in people's minds in the background when this push for fintech and decentralization came up. So I think that there is no doubt that the financial crisis of 2008 played a big role in the emergence of fintech and decentralization. The other thing to say is, you can talk all you want about decentralization, but it's actually not that easy to do it in a decentralized way. And here is where technology played a big role. So it's really this combination between the broken trust and the technology that all of a sudden enabled rethinking about the financial system and thinking about how to do it in a decentralized way. This was really a good combination that gave rise to fintech. What is the promise of decentralization? Okay, as I said, I'm going to give you a mixed message by the end of the talk today. It's not going to be a praise of fintech or DeFi. I don't know how many people here are DeFi skeptics and how many people are DeFi enthusiasts. I'm guessing there is some mix. From what I heard in the panel this morning, there are quite a few skeptics in the audience, but I know some people are also feeling more strongly about it. I'm going to give you a mixed message because I think we have to look at it at a balanced way. There are some positives and there are some negatives. And at the end of the day, I think we are going into an equilibrium that will be a little bit of a mix of the two. But before we understand the negatives, I think we also want to understand what was the promise, why people were so into this idea that we need to decentralize the financial system and get rid of the big financial intermediaries. And I would say that there are three reasons that come to mind that are often mentioned. One is when you have a big financial player, there is a big concentration of risk. There is a big concentration of failure risk. And when you decentralize the system, you are spreading this risk. And as a result, it becomes less pronounced. Okay? So you basically can think about trying to eliminate the systemic risk the risk of systemic failure. That's one. The second reason why there was such a passion to decentralize the financial system is the idea that the big banks, the big financial intermediaries, are capturing a lot of rents. Okay, and this came very clearly following the financial crisis of 2008. The idea that they are taking the risk, they are taking the profit, but they are, at the end of the day, not paying the price if things fail. So when you have a centralized financial system, the big players can capture economic rents, and the push for decentralization was in some sense a push for breaking that economic power, breaking the power to capture economic rents. Third motive behind the decentralization push is the idea that we can make things more efficient and offer a larger menu of activities when we move to a decentralized system. So two things to note here. One, there are many assets in the financial system that are traded in a very inefficient way. And some of it is attributed to the fact that things are old and captured by big intermediaries who have little motive to change. Okay? Think about how corporate bonds, for example, are traded, or how houses are being bought and sold and transacted. All these things take time, illiquid, and can certainly be made better. The idea was that if you create a decentralized system, you may be able to do it better. Second, currently, there are many assets that you can't really trade. And the thought was that with the decentralization, you could potentially introduce a larger menu of activities and things that could actually be transacted and value that can be exchanged. One thing that comes to mind here is the trade of art. And you all heard about the NFT, non-fungible tokens, which was essentially an attempt to do that, to use the technology in order to start exchanging ownership over new types of assets. Okay? So those were the three motives behind decentralization. And certainly there is a lot for it. Eliminating systemic risk, eliminating economic rents, making things more efficient. Certainly those are good reasons to want to have a decentralized system. Let's see to what extent it actually works. What are the problems that we are seeing? And I'm going to start, as I said, with the case of peer-to-peer lending, which back then, when we started looking at that, 2017, was really the dominant issue when you think about FinTech. There was a big promise behind it, but nowadays we see that it really didn't stand up to the promise and didn't deliver the kind of change that people were hoping for. So I'm going to go through the case study of peer-to-peer lending and try to think about what we learned from it. Then I'll move on, talk about the current things, the blockchain and the DeFi. So peer-to-peer lending had a wonderful idea behind it. Think about how people are lending and borrowing. Say that I want to get a loan from a bank. I need to go to the bank, apply for a loan. The bank will have to decide whether to give me the loan or not. Now, the bank is typically not using its own money. Rather, the bank is using money that is coming from people who actually have money and don't have anything to do with the money, and they want to keep their money in the bank to get a return. So what the bank is doing is intermediating between the lenders and the borrowers. What peer-to-peer lending was about, it was essentially saying, okay, let's get rid of the bank. If we can create an online system where lenders and borrowers are going to match automatically through the system, lenders can find the borrowers that they are interested in. Borrowers will get their money, lenders will get their return. Everything will be done much more efficiently to both the lenders and the borrowers, and we will not need the banks in the way. Okay? So that was really quite a powerful idea. It started taking off in China, and there was actually a pretty good attempt in the US with Lending Club and Prosper as the two leaders in that industry early on. Okay? But what we started seeing is that the model did not live up to the expectation. Okay? Yes, in the beginning, households went on the platforms of Lending Club and Prosper and found borrowers. But at the end of the day, when you looked at that, they realized that they were actually not making very good deals. At the end of the day, what happened was that the big financial intermediaries started taking over. Okay? So instead of this being a peer-to-peer platform where individuals are lending to other individuals, what happened was that the banks saw that as a convenient platform for them to work with, and they started using this for their own lending decisions. Eventually, what they did was to crowd out the individuals, the retail investors. Okay? It kind of became ironic that very recently Lending Club started essentially disallowing retail investors to invest on its platform. So now it's a pure institutional platform. So basically what you see is we do have the platform there. The platform works. The technology works. But when we look at it, it doesn't look that different from the kind of equilibrium we had before. It's still now the big institutions, the big intermediaries, and we see the retail investors essentially being crowded out. Okay, so I would call it kind of an early failure of the concept of decentralization that should raise some alarm bells when we think about it going forward. There are actually strong forces that push back towards centralized finance, and I will continue to highlight that as we go along. Okay? So why did it happen this way? When you go back to the theory of economics and finance, you realize that there are actually some very good reasons that banks and big financial intermediaries exist in the first place. Okay? They are not there by chance. There are actually economic reasons for why they are there. And I can name here 3. Okay? These are things we study all the time. And I can go into a lot of detail, but to stay brief, I will just quickly name 3 such reasons. Financial intermediaries, banks, they clearly have the informational advantage. They know how to screen. They know how to pick good borrowers from bad borrowers. They also have the ability to monitor. So they have the ability to give someone a loan and then check what's going on and make sure that they are complying and doing everything they can to pay it back. And something else that they do is they provide a lot of risk sharing. If you are doing a loan yourself as an individual, you are taking the risk. A bank is going to make a lot of loans and then essentially spread the risk. And this is one additional advantage of having a big financial intermediary. So financial intermediaries are there for a reason. And we kind of saw that with the peer-to-peer lending. I think the fall of peer-to-peer lending basically tells us that there are strong forces that push back towards centralization, and we may want to think about them going forward as we think about a future of decentralized finance. So that's kind of an early experience. I'll take a quick detour here just to say, when I talk about peer-to-peer lending, I'm not talking about fintech lending in general. Fintech lending has actually done quite well during that time and continues to do quite well today. What I show you here on the slide, which is probably too difficult to see, is just a snapshot of fintech lending nowadays in the US. And you will have access to it later. So you can look at the numbers. But basically, if you look at it, you will see that fintech lending, for example, in the area of mortgages, is booming. Okay, it's going very fast and it's very profitable, starting with Quicken Loans, but then also with other players as well. It is still early in other areas of finance, but it is starting to grow there as well. So fintech lending is doing well, but I will make a clear distinction between fintech lending and peer-to-peer lending. Fintech lending is essentially another player that is not a bank that starts doing essentially the same things that bank will do. That's not the old, the idea of the peer-to-peer lending that we started with, where you decentralize everything and you don't rely on an intermediary. Okay? So thinking about the fintech lending is doing very well for multiple reasons. The technology enables the fintech lenders to provide convenience. They're doing things with better service and higher speed. They are not bound by regulation, so a lot of the restrictions that apply to banks do not apply to them. Certainly there is a lot of innovation with fintech players, and as a result, they can come up with new products. One thing that we heard about quite a bit recently is the buy now, pay later, for example, which is a fintech product that gained a lot of momentum. They're also relying on data to a large extent, and this enables them to make better lending decisions. Overall, if you ask whether fintech lending is a good innovation or a bad innovation, I would tell you that the views are mixed. On the one hand, certainly they made credit more available. On the other hand, it is not clear if they really reach those populations that otherwise would not have access to credit. And it is also not clear if they encourage the right type of credit or just encourage people to overspend. There's a big debate about that. But we will leave that aside. I would say about fintech lending, it is certainly doing well. It certainly has a lot of advantages over banks. But it's not the decentralization reform that people had in mind in the beginning. It is essentially just one financial intermediary replacing another financial intermediary. It is not this decentralized system where everything flows seamlessly in a system that does not require the intermediaries. Okay? So this brings me to the final part, which is everything that is going on today, these days, with blockchain and DeFi. DeFi, the name doesn't hide what it is. It's all about decentralized finance. And that was the original motivation behind blockchain. So let me give you a quick tour over what it is trying to achieve, and then connect to some of the challenges that I think, to a large extent, are also related to the problems that we saw with peer-to-peer lending, although not entirely. Some of it is new. So let's start with blockchain. What is a blockchain? A blockchain is a distributed ledger. It's a technology that allows you to have a distributed ledger. A ledger is basically where you keep records of ownership. And usually this is kept by the financial intermediaries, for example, a bank or the government. A blockchain is an attempt to make it all distributed, such that no one has control over it. It is updated by different people in the system, and it is done with no concentration of power. So there is no individual entity that has control over the ledger. The information is supposed to be shared by all at all times. So again, there are no frictions in a perfect blockchain. And clearly when we think about what is the application of it, the first thing that comes to mind is Bitcoin. Bitcoin was the first and still by far the most famous application of blockchain, and I think also highlights many of the challenges that we face. Now, what is it here for technology? So blockchain is a technological advancement. It is all enabled by technology. I'm not a computer scientist. I don't know how many of you are here, but this is something that computer scientists are working on, and there are a lot of interesting synergies between finance people and computer scientists on this dimension. One thing that I think everyone has heard of is that in order to have this process where the ledger is updated in a distributed way, you need to have some protocol. And traditionally, it was the proof of work protocol, which is what Bitcoin, for example, is based on. It is this thing that when you first hear about it, you have a hard time understanding how it works. But when you go more and more into it, you see kind of the logic. But it's basically creating a competition among different potential validators who are validating transactions. They are called also miners. It's a competition. They have to compete on solving complex computational problems, and those who win the competition get to verify the transaction. Okay, that sort of worked. I'm going to talk about some of the main challenges, but one thing that is very clear, and I'll state it right now, it became very clear very fast that this is humongously inefficient, because this process where different potential validators are competing on doing transactions just consumes a lot of energy. And in our day and age of ESG and climate change, that's not a good thing to do. So this is proof of work. Now, because of these problems with proof of work, now there is a new thing that is proof of stake. And the sort of next big thing after Bitcoin is Ethereum. It is based on proof of stake. Here, in order to validate a transaction, you basically have to stake some of your coins. And people hope that this is going to work better, but I think this is still highly debatable. Okay, so that's what blockchain is about. Now, on top of blockchain, there are other things. It's not just the blockchain itself. There is also the smart contract, which is basically an arrangement in the system that is going to be built on a blockchain and is going to execute itself. So it kind of says, if transaction X has happened, then Y is going to be triggered, something along these lines. Smart contracts are the next layer above the blockchain. And then when you take this collection of smart contracts on a blockchain, you get what we call DeFi, okay? A decentralized financial system, DeFi. And this is supposed to be a collection of applications that allow people to do all sorts of things related to financial transactions. It is meant to replace the traditional financial system, so-called TradFi. And it is meant to do that by essentially getting rid of the intermediaries. This is the original motivation of decentralization that I talked about. Again, Ethereum is sort of the most well-known of these DeFi systems right now. Okay, so that's the idea behind blockchain and DeFi. What is it used for, and what can it potentially be used for? So I'll mention a few things here. First, which is currently the most prominent, is cryptocurrencies. Okay, we heard about them a lot. Were mentioned in a couple of panels today. Certainly, people have strong views in both directions, I would say. A cryptocurrency is meant to replace a traditional currency. So instead of using a government-issued currency to perform a transaction, you can do it with a cryptocurrency, which is essentially a currency that is run on the blockchain. Again, Bitcoin would be the one that everyone knows, but by now there are hundreds of them in circulation. And we keep hearing some horror stories about how they collapse and go up in flame. So certainly a lot of action around cryptocurrency. But the idea is to try to replace money with that. So using that blockchain system, you create cryptocurrencies that could potentially replace money. Another thing you can do with it, which is a close cousin of cryptocurrency, is token. Token is also a currency, but it's a currency that is specific to a particular platform and is meant to be used for buying services on that platform. So for example, Ethereum has its own token that is supposed to be used for whatever you do on Ethereum. But then you have a lot of other things, like those small, starting small companies that start providing new distributed services and operate them with tokens. You know, one thing that comes to mind is Filecoin, where you exchange server space online. So you can lend your server space to someone else who needs that. And it is operated with a coin, Filecoin, that people are using in order to pay for these transactions. So these are all coded on a particular blockchain. You know, there's been a big boom of that. So back 3-4 years ago, a lot of ICOs, initial coin offerings, many firms were basically starting their own coins. There was a lot of excitement about that, but then it turned out that a lot of them was just fraud, and it kind of stopped. And now regulators are trying to figure out what to do with it, how to get the good without being exposed to all the bad. Okay? These are two main uses. But then there are a lot of other financial applications on DeFi that are currently being pushed and tested. And you know, I think if you follow this, you hear more and more about it. But even if you don't follow it, you probably heard some of these terms before. You know, one thing is trading. So there is a smart contract on the DeFi that basically conducts automatic trading based on an algorithm that does not require a financial intermediary. So this is what we call a decentralized exchange with an automated market maker. Okay, we hear about it quite a lot. Uniswap, for example. There is lending and borrowing. So you can lend one asset, borrow another asset, and you can all do it again in an automated way on the blockchain. And then there is this new thing called yield farming, which again is a smart contract that enables you to use your coins in the best possible way and generate the highest return. I would say all these are things that are currently running, and you can actually study them to great depth. There are a lot of attempts to do that. But one thing to say is that this is all still, I would call it, at the proof of concept stage. It is in many ways not used for anything real. It is just used within its system. So you can think about it as being self-referential. Okay? You are, for example, using this decentralized exchanges in order to trade different cryptocurrencies. But you're not really using them to trade bonds or equities. So it still hasn't really been tested in the real world, so to speak. But it's still kind of interesting to see how it works and think about maybe at some point it can be used more in the real world. Okay? So, you know, I'll try to finish in a few minutes and get questions. You can see here sort of the volumes of activities and values behind some of these applications. Another thing to mention, another application is the stablecoin. You know, Terra was a notorious example that did not go very well. But we also have Tether that people have, I think, more faith in. The basic demand there is because the value of cryptocurrencies goes up and down so much over time, there is some desire to have something that is more stable. And the way to create this stability is to have a coin that will be pegged to something stable, and this is what we call a stable coin. Terra was a bad example because they refused to peg it to assets from outside the crypto system, and then there was really no assurance that this thing can be sustained, and it ended up collapsing. Tether, I think, is more viable because it is trying to peg itself to assets outside the crypto system, like government bonds and corporate bonds. However, there are still issues with that as well. In general, what we know in finance is when you're trying to peg one thing that is volatile to another thing that is stable, you tend to run into this issue of runs. Everyone might want to take their money out at the same time, and then it all collapses. Okay? So I think this is what we are still looking at with stablecoin. And you can see here kind of how stablecoin are related to the other applications that I talked about. Let me finish off by talking about the limits of decentralization that we clearly see with the blockchain, the DeFi, and the various applications. I think first, the experience with peer-to-peer lending is a big alert that I think we should all keep in mind going forward when we think about blockchain. But when we look at blockchain itself, we also see that there are forces that push back to centralization. Okay? If the idea was to have everything distributed without any concentration of power, it turns out that with proof of work, the original protocol for Bitcoin, it didn't really work that way. The reason is that there were economies of scale, and all these validators realized that they should concentrate power. They should pull together, they should invest a lot in resources such that at the end of the day, they will have control. So we ended up with maybe getting rid of one financial intermediary, but certainly pushing the concentration of power elsewhere. So the limits of decentralization were pretty clear. The other things that blockchain is facing is the operational channels. And I mentioned the fact that with proof of work, there was a huge energy waste. I think proof of stake is still early to tell. Okay? There are some issues that are starting to emerge, but it's still early to tell to what extent this is going to be a seamless solution. And finally, another challenge here, operational challenge, is what we think of as the impossibility triangle. This is a well-known theory in blockchain. The idea that what blockchain is trying to achieve is consensus, decentralization, and scalability. But at any time, it can only achieve 2 out of the 3. Okay? So if you want to have consensus and decentralization, for example, which is what they started with, you have to give up scalability. And that's a big thing. You can't really do it in a meaningful way if you give up scalability. Okay? So that's something else to keep in mind. The final set of challenges, I would say, that are clearly very important are the issues of trust and regulation. We started with blockchain and Bitcoin because we wanted to bring back trust to the financial system. But when people look around and see what's going on with blockchain, with crypto, I don't think it generates much trust, to say the least. There is a list of issues here, just thinking about their volatility, just thinking about the scope of fraud that we had with ICOs, thinking about some spectacular failures like FTX or the collapse of the Terra stablecoin. All these things are really hard to comprehend, and I think do not give people much trust in this system. And of course, there are the regulators. Okay? The regulators are looking at all that and are not quite sure what to make of it. And I think they have more questions than answers. Should they treat coins as securities? Should they treat those platforms as intermediaries? How should they apply all the regulation that is in place to detect suspicious transactions? What about international coordination? All these are issues that are still up in the air, and I think provide a lot of uncertainty when thinking about this space going forward. So I'll conclude, just give you the gist of what I said. The fintech revolution, to a large extent, was a push towards decentralization. I think there are many good reasons behind decentralization. When you think about the financial crisis of 2008 and financial crisis before that, there were clearly many reasons to be unhappy with the financial system as it was developed over the years. But when we look at the development of decentralized finance, starting from peer-to-peer lending and going into blockchain and DeFi, you realize that this is not a panacea. There are many issues, and going forward, I think we are kind of moving to an equilibrium that maybe will have some of these benefits, but certainly, in my opinion, is not going to go all the way to an equilibrium of decentralized finance. Maybe you want to think about it more as partial decentralization. And of course, there are many other obstacles to to take care of on the way with operation, legal issues, and things like that. So I'll stop here. Let me check for the questions. And I'm also happy to, I don't know if, maybe it's better to just take them with a mic. I think it's, So I'm happy to take questions with a mic. Anyone? There's a mic in the back. Yeah.
This is related to trust. These new fintechs so far have not replaced the role of the banking industry, of the bank, to just place your money. Are you going to place your money with a fintech?
Yes.
Question.
That's exactly what I was saying. That's exactly what I was saying. I think the original motivation was to bring back trust to the financial system, because I think there was this idea that you cannot trust the banks, but the system that was developed that is potentially competing with the traditional system is certainly not giving people many assurances. So I certainly agree with you on that. Okay, and I think those are the issues that need to be worked out. Okay, so that's, I think, one of my last slides was exactly about that. When you look at the failures, when you look at the volatility, that's not something that gives you peace of mind.
Which does not mean that there should not be a better control of the banks, which, in fact, this control has been put in place. A better control, improvements. Let's call them improvements. Have been put in place since the 2008 crisis.
Right.
So improving things does not mean replacing things.
Yes, I agree. And, when I talk here about partial decentralization, I think that's kind of what I have in mind. I do think that some of these technological improvements are viable and can be used going forward, but I don't see them going all the way to a fully decentralized system. So there will be some combination of banks with platforms, and that, I think, is something that can be improved going forward, yes. There are more hands, but I can't see with the light, so I don't know if you can. Yeah.
You alluded to this briefly, but I wonder if you could elaborate. Increasingly, there's been a role for financial institutions to monitor criminal activity. Have there been any proposals as to how DeFi institutions might have this responsibility?
So this is one of the main issues that regulators are trying to grapple with. And there is legal work on trying to do that, especially when blockchain and DeFi becomes more operational and starts serving the bigger economy. In general, I would say, I think it is still pretty tough to imagine how this will work. And the issue is, first of all, the decentralized nature of DeFi, which is really the basic definition. Because when it's so decentralized, it's sort of hard to tell how to enforce it, who exactly you're going to force it on. The second thing that is a big issue is the anonymity. And that was, again, part of the initial appeal of blockchain, the fact that you can do things anonymously. But once it's anonymous, it's again, very hard to track. So those are big issues going forward. When I thought about those legal challenges, I would say that's a main one.
What about coins backed by countries' government and it's just pegged to the country's currencies? Do you see it serving a good purpose? And what's the problem of that? Is there any problem with that approach?
So you're talking about the CBDC, a central bank digital currency, or?
Right. Why is it not adopted more by more countries?
Yes. I mean, overall, I have a favorable view of CBDC. I think there are some operational issues that governments are trying to sort out, but certainly there are many countries that are thinking about it and trying to do something. There's a bit of a competition to think about, who will do it first and what kind of advantage they will have. But I think this is something that we may see some progress in pretty quickly. That's certainly using the technology, but it doesn't have the original vision of blockchain in the sense that it's certainly not going to be decentralized. But I do think that is overall a positive thing, just for the convenience. Yes. We have we can take a couple more. Yeah.
Thank you. So this question is a little bit opposite to the question from the gentleman on the left. Certainly what happened last year with the fall of a lot of centralized crypto exchanges, et cetera, service providers, it's laid bare the fact that this industry is in many ways naked. You have very little controls. They're operated by people with very little experience and also a lot of greed. So more controls, more safety for users of these platforms is certainly something that I'm looking forward to. On the opposite end of that question, though, is when is too much regulation too much? Because from people who have been active in the space, and especially people in Singapore and Hong Kong, what sometimes we've experienced is overnight changes in the regulations and the things we're able to do in ways that are clearly detrimental to investors who are capable of making educated decisions on their finances. Certainly, you're protecting investors who are not in that same category, but you're also hurting a lot of people by taking away access to a new asset class. So how do we think about when regulation is too much or is too heavy-handed?
That's a difficult question, because I think regulation is always about trying to find the right balance. On the one hand, you don't want to regulate too much, but you also don't want things to go out of control. So I think it's always about finding the right balance, and I think most regulators would have that in mind. Certainly I would not say just go and ban it. I think that there are many negative aspects to that. But I think that as you look at it more over time and kind of see some of the experience and certainly some of the illicit activity that happens through it, and all these some flawed products and how much money people are losing as a result of them, I do think there is a reason to think more about regulation and limitations. I think it's really just like with any other regulation that we see, even banking regulation, it's really just a constant battle to just try to find the right balance between the forces. I hope that we can have a system where the different things are available and they work well. But certainly I think the experience we saw in the last few years or even last few months led people to believe that maybe you need to do a little more.
I think the issue is that, one side does something and then the other reacts. And it's almost like a cat and mouse game. It's not as collaborative as I think it could be.
Yes, there is a lot to say for that. I agree with that. I mean, I would say in general, the whole philosophy of how to regulate those entities was very unclear in the beginning. And I think regulators are still not quite sure what exactly they are trying to achieve. So in some sense, it's kind of finding what you want to do as you are doing it.
Thank you.
Yeah. I think there's another one now.
My question is more on the fintech side rather than on the decentralized finance. So if I read correctly, one of your previous pages, I think it was page 15, is that out of the 16 trillion of mortgage loans in the US in 2020, around 600 billion of them were through fintechs, right? So that's like 5%, which for a pretty conservative and pretty old school product, it's quite significant, I'd say. So do you foresee any big shift from, let's say, traditional brick and mortar or big name banks like the Wells Fargo's and the Bank of America's to smaller houses and to smaller firms that will eventually eat up the market share and replace those institutions in even like, what's supposed to be their home turf, like mortgages?
I mean, I think to a large extent we are seeing it. Fintech lending has grown a lot in the last few years, and a lot of it was in the mortgage area. So I think those fintech lenders are here, and they are conducting a lot of the transactions. Banks are kind of trying to respond, and I think they are improving their processes in order to be competitive. But certainly I think going forward, it is quite reasonable to think that we'll have those two routes, the fintech lenders and the banks. So I think we are out of time now. Okay, thank you.
Thank you.